In today's video, we're going to discuss this report that has just come out by TD that Canadian home prices could drop by up to 25% by early 2023. I'm going to go through some of the frameworks that I've recently learned from Warren Buffett and Charlie Munger, some of the greatest investors of all time, regarding forecasts, predictions, and how to use the information that's in front of us to effectively make our investment decisions. Now, before we get into it, I want to share a quick promo that we have for our upcoming investment tour in the city of Welland. This is a tour that we're going to have available for free for those of you who are interested. And we'll be showing a few of the triplex conversion projects that our clients have purchased and are currently renovating. If that is something you're interested in, if you're interested in investing in the Niagara region, that is definitely something to check out. It will be a link in the comments below. But let's quickly check out the tour.
Hey guys, Koukun here. We are at a investment property in the city of Welland and we just completed our investment tour. So these investment tours, we take out some of our new clients to check out a few different projects that are either currently under renovation or complete, just to get an idea of the before and afters. We typically go through the numbers on a project like this, sort of purchase price, after repair value, go into the rental numbers if it's already been rented. So if you're interested, click the link below.
All right. So again, the link is in the comments below if you're interested in signing up for our next tour. So here is the article. Canadian home prices could drop by up to 25% by early 2023. This is on the Financial Post. There's a few news reporting companies, I guess, that are sharing about this same article. And it goes into saying that it could fall by up to 20 to 25% from the peak. It's the worst decline since the late 80s. So let's dig into this a little bit further. And I actually have the actual report from TD that we can go into the details instead of sort of the brief outline that is in this article. And it's usually the headlines. Everyone's interested in the headlines. But before we get into that, here are some words that I'd like to share from Charlie Munger. So in one of the annual meetings of Berkshire Hathaway, Charlie Munger is sort of the number 2 at Berkshire Hathaway, which is the company that Warren Buffett runs and has been running for the last 50 odd years. And it has the greatest investment track record probably in the history of investing. They have compounded their money at 20% per year for 50 years, which is literally over 1,000,000% return. So it is a crazy outcome. So here's what Charlie Munger has to say. Around here, I would say that if our predictions have been a little bit better than other people's, it's because we've tried to make fewer of them. Warren Buffett. I have never had an opinion about the market because it wouldn't be any good and it might interfere with the opinions that we have that are good. If we are right about a business, if we think a business is attractive, it would be very foolish for us not to take action on that because we thought something about what the market was going to do. So here are two of the greatest investors of all time saying they basically don't ever try to predict what the market is going to do. So when they do say something that can be looked at as a prediction, it's usually right because they try not to do it. So they only talk about it if it's blatantly obvious. And they don't try to use those predictions in their investing, at least the general market predictions. You do, on some level, have to make a judgment and a decision in order to invest. But it's better to make those sort of predictions and forecasts when it around a specific investment or a specific area instead of broad predictions. The specific predictions can be more useful to you. So for example, Warren Buffett, when he finds a business that's attractive, he's making a prediction that that business is going to do well over time. He doesn't know for sure, but he has a higher amount of certainty than his prediction of what the overall market would do. All right. So I'm going to share something that actually comes from this heavy book over here. So Poor Charlie's Almanac. This is a great read for any of you who have not read it yet. It is the book by Charlie Munger, and it goes over various topics that are very insightful in my opinion, one of which is the 25 causes of human misjudgment, psychological causes of human misjudgment, which Charlie Munger basically looked at all the things that appeared in his life of really crazy scenarios. He would see intelligent, smart people do things that are completely dumb, and he wanted to know why. And he would look at the psychology professors and the what's taught in universities on psychology, and he found they were so focused on what could be measured that they would leave all of these huge golden nuggets of information that were plainly obvious, that may not be easy to measure, but it was obvious that it was there, and they would just pretend like it didn't exist. So I read through the 25, I took notes on all of them, and what I've tried to do more recently is whenever I come across something that in my mind doesn't seem to make sense, I've tried to frame it through those tendencies, and I found it very helpful in terms of understanding why something that doesn't make sense happens, which is a very useful tool to have. So let me share this with you. This is my interpretation. So fooled by forecast. So if basically, I'm trying to understand, why do people like forecasts, especially like the ones offered by a big bank, TD, saying that the market is going to continue to go down. So let's take a look here. The first one is the reason respecting tendency. This is a very fascinating psychological tendency. We tend to respect people who say why, even if the why doesn't make any sense. So this is very fascinating to know. It's very good to be aware of, so that if someone gives you a reason for something, you don't automatically accept it because they gave you a reason for it. But it's very useful to know. There was a test done, actually, I think this was by a psychology professor, where he had people stand in line. Or he would go to companies where people were standing in line in front of a photocopy machine. And basically there were three scenarios. This experimenter would go to the front of the line. So 5 people, for example, waiting in line, he would go to the front of the line and ask, can I make some copies? About 64% of the time, they would allow him to sort of cut in line and go, which is interesting to know. There are people in line, but you're just letting this guy go who's asking for it. The next scenario is that you would go to the front of the line, you would ask, hey, can I cut in line? I'm in a huge rush. I really just need to make a copy, but I'm in a huge rush to get out of here. Can you please help me out? In those cases, 96% of the time, the person at the front of the line would let this person cut in line. The third scenario is the most fascinating, which is the person goes to the front of the line and simply says, can I cut in line because I need to make some copies? He's giving a reason why, and 94% of the time, so just 2% less than the 96, right? 94% of the time, they would let him cut in line, even though the reason doesn't make any sense. Everyone waiting in line is trying to make copies, but simply because this person said a reason, the person at the front of the line accepted that. So in my opinion, we tend to get fooled by forecasts because there's always a reason. There's always a reason why what they're saying may make sense. The next one is authority misinfluence. So this is probably widely documented, and it on some levels it's credited for why Hitler was able to have create or run the Nazi party and do the crazy things he did because he was in a position of power and authority. And we see this in many areas. So with authority misinfluence, we tend to follow a leader or an authority. And in this case, for example, TD is one of the leading banks. They're analysts. We assume the brand behind them. We assume that they know what they're talking about. So we give them that credibility because of the authority we may give an institution like TD. One of the antidotes to this is to ask why. It doesn't matter who's saying it. You should ask why, and then you should see if that why makes sense, and don't accept a reason respecting why that doesn't make sense. You should ask why and make sure that what they say makes sense. The next tendency is contrast misreaction. So as individuals, we do not look at things in absolute values. We tend to look at things relative to something else. So because of this, in terms of contrast, when we see, for example, low interest rates, now all of a sudden high interest rates or rising interest rates, that contrast is very visible to us. A much harder thing to view is population growth, which grows at about 2% a year on average, I think, in Canada, which is a relatively small percentage, 2%, but over long periods of time creates these massive impacts in terms of the availability of housing and the demand for it. But it happens slowly. So we don't see the big difference from one year to another. Instead, we see house prices decline, interest rates go up, monthly payments go up. We see those big changes that are right in front of our face. And as a result, we prioritize those things. We put more weight to what we can see, right? What we can see with that contrast. The next one is called Deprival superreaction tendency. And this is widely known. It is the tendency where the feeling of loss can be greater than that of gain. So a simple experiment is the person who finds $100 on the floor is happy to a certain level. The person who had $100 in their wallet and lost it is much unhappier, like quantitatively much unhappier than the person's happiness when he finds $100. And there's, again, many studies to show this. Something kind of related, but maybe not the same, is how if for example you work with a plumber who did a good job, you will refer that plumber to your friends and family. If someone does a bad job, you will tell all your friends and family never to work with that person. And apparently it's been studied that the negative news travels, I forget exactly, but I think it was 5 times faster than positive news. And I think it's a variation of this where what they lost was so painful versus what they gained was only so much. So for example, in a scenario like this, if you own real estate and if you fear that the value of the property you own is going to decline, that is a loss. That brings a feeling of pain, usually. And if the real estate goes up in value, you're happy, you're euphoric, you may want to buy more properties, right? But the feeling of pain may be much greater than the feeling of gain. So, important thing to note. And finally, this is fascinating, the doubt avoidance tendency. This is something that I found very powerful, and basically it says humans do not like things that are not clear. It is tough to make decisions where uncertainty exists, and as a result we avoid having this doubt by trying to make a forecast even if it may obviously be wrong. This is fascinating to me because if there is a gray area where it's not black or white, yes or no, true or false, it's hard for us to stay in that gray area and determine that it is not possible to know yes or no, but rather just accept that it is hard to know. Instead, we would much rather decide, say, yes, it's going to go up. No, it's going to go down. Yes, that the overall market is going up. No, the market is going down. We're in a bull market. We're in a bear market. It's easy to go to one side. It's hard to stay in the middle. And when someone gives us a forecast, we love it psychologically because it tells us, oh, this is going to happen. No, that is going to happen. It allows us to choose one side or the other instead of the reality, which is it's probably tough to know, and you may be better off not thinking about it and rather focusing on what you can know. And just if you want to look at a couple of examples. So in 2020, CMHC predicted that we were going to see a 18 19 to 29 sales decline and a price decline of 9 to 18%, but will recover in 2021. This was CMHC's prediction, and it got a whole bunch of news back then. This was when COVID just started. And again, respected institution, CMHC, they're coming out, they're giving the reasons why, they're saying how COVID is going to affect everything, how everything's going to happen. And I'm not saying that they were incorrect in their analysis. It's just that making predictions or forecasts is incredibly difficult and complicated, that I believe on some level no one gets this right. So here's an institution trying to get it right. Another one, Bank of Canada, back in 2021. Inflation is transitory. If you remember, those words were widely said. Inflation is transitory. And they're like, yeah, it will go back down in, end of 2022, back to 2%. And it may actually go there if they increase rates fast enough. But it goes to show the difficulty of making any forecast. And the Bank of Canada governor is literally in the business of making forecasts, because all the data he sees is past data, not present data even. And he has to make a forecast of what his decisions are going to affect the future. So he has a very tough job. I don't envy him. But again, here are two distinct examples of respected people with authority, institutions with authority, that are giving good reasons why what they're saying makes sense. And usually it's in a time, for example, when COVID started, there was a lot of worry and pain. And here's someone coming, giving an explanation why, and we want to avoid the doubt. We want to decide. What happens when all of these work together? The final one that Charlie Munger really points out is what's known as the Lollapalooza effect. When multiple psychological tendencies work together, they can create a result that's bigger than the sum of their parts. So as a result, when many of these work together, the result may be more than each of them by themselves. And it may create these, in this case, you believe the forecaster. They do enough things that align with your psychological tendencies. You want to believe them. It may not serve you though. So let's look at the housing forecast. So there's a few questions, and I'll leave a link to this in the description below. It's well known that the housing markets are softening. Boarding costs have jumped. Again, a true fact. They're giving a reason, right? And they talk about the actual numbers so far. The national home price has already declined by 9%. Great, they're using some stats. How deep will the correction be, and how long will it last? How do they know? All the data in the world cannot help them make an accurate prediction. But they somehow are trying to do it by saying it's going to be 20 to 25% on a peak to trough. And they even have the quarters. It's going to be from Q1 2022 to Q1 2023. The sales are going to crater by 35%. And they're talking about some of the regional differences. Recalibration. This, I think, was the most useful part of this. What is your longer term view of the market? And this is where Warren Buffett's view is very valuable. One of the things that Warren Buffett says is it's important to understand what will happen rather than when. The when is very difficult, but if you know what will happen and you can stick to it long enough that the when happens, you will get a good result. So for example, here they talk in the long term, we're more positive on the outlook for housing. The population growth should remain healthy. 432,000 new permanent residents coming in yearly. The targets are maybe lower than they were before, but that number is going to go up. And anyway, so they say basically that the long-term outlook for real estate is going to be good. And then they talk about how housing's impact is going to be on the overall economy. So again, when it comes to real estate investing, you want to focus on what will happen rather than when. And basically, based on what even they said, We in the province of Ontario, in the Golden Horseshoe, Toronto area, GTA, and even the Niagara region where we focus on, we have an incredible population growth. That is what is going to happen over the long term, which is very hard to see because our contrast misreaction tendency cannot see population growth. It happens very gradually. The traffic increases just a little bit more every year. We see just little signs of it happening, but it is not right in front of our face. So that is something that is happening in the background. We don't know when those factors will create, some crazy effects. We're already seeing it now, in my opinion, but it's easier to focus on the increase in interest rates because that is right in front of your face. But anyways, that is happening. More people will need real estate in terms of rental housing or homes to own in the next decade, 2 decades than currently or in the past. So my framework for real estate investing is buy a good house in a good neighborhood. Buy a house that structurally sound, is not going to cause a lot of issues and costs over time, and it's in a good neighborhood, it's in a city, and it's in a neighborhood that people want to live in. You're going to have demand from tenants, you're going to have demand from home buyers if you want to sell the property. Then have a margin of safety. If you're buying a property with debt, you're borrowing money, you need to have a margin of safety. What does that look like? Some people say they want to buy real estate at a discount, and I like to get a good deal, but that's not necessarily my focus. My focus is I want to have a margin of safety in the form of cash flow. So if I can find a good house in a good neighborhood that produces positive cash flow, that gives me my buffer. If interest rates rise, there's a buffer of income that can support those increased payments, right? And long term, those rents are going to increase if it's in a good neighborhood and if we exist in a place with population growth. So that margin of safety keeps me in the game so that I can do number 3, which is nothing. I just hold the property. I wait. I don't make decisions based on forecasts by TD, CMHC, the Bank of Canada, by anyone. I stick to what I know works and I do nothing. And as long as I have a margin of safety, I can ride the ups and downs that may come with higher rates, with vacancy, recessions, whatever may come in the next decade or 2 decades. My margin of safety and my initial criteria of buying a good property are going to produce some incredible results, I believe, in the long run. So, hope you found this video helpful. Again, not bashing the information that is in this report. You can take a read of it yourself, but I would advise you highly look at it through that framework of the psychological tendencies. Are they simply giving you reasons that sound like it makes sense, but in reality you don't actually know? Are they trying to help you avoid doubt by giving you clear percentages of what real estate is going to drop by and quarters by which it's going to happen, right? Again, how do they know? And don't give people the benefit of the doubt that because it's an analyst working at a big bank, they should know what they're talking about. Warren Buffett and Charlie Munger, whom I believe are some of the greatest investment minds that we've ever seen, say that they can't predict and they know their limitations. And I don't even have a drop of confidence that some analyst working at a bank knows better than them. So again, do what makes sense. Make your decisions wisely. Investing is a personal decision, so you have to decide if it's right. That investing framework is how I make investment decisions. If you find it helpful, feel free to copy it. And again, if you are interested in joining our Welland Investment Tour, there'll be a link in the comments. And if you're just finding us for the first time, check out our free beginner's guide to investing in the Niagara region. It's a free PDF that you can download with some of the information why I think the Niagara region is going to continue to grow into the future. Hope you found that helpful. Until next time, all the best.